Good morning, everybody. Welcome to the Flow Show. It's Tuesday, the 7th of November. Good morning, Kay. How you doing, mate?
Good morning, Ryan. Good morning, everybody. I'm doing all right. The feeling of a small hangover, having been awake for an hour and a half over the RBA last night. So my old bones are saying I shouldn't be doing that every time.
Yeah, burning the candle at both ends again. Gets harder and harder, doesn't it?
It does, mate. I mean, honestly, it does. I mean, the wake up is okay, but then afterwards getting back to sleep and then the next morning feeling a bit under the weather, right?
Yeah, a bit jaded. Yeah, I know that feeling well, mate. Well, the things we do for trading, eh? Anyway, let's have a look at what's been going on. I'm going to start with some data, I think. I've got things set up on that front. Some Chinese data out overnight, trade balance data, a little bit softer on the surplus there. Activity wise, a bit of a mixed picture. Exports down significantly, down 6.4%, were only expected to fall 3.3%, but imports were expected to fall nearly 5%, but came in up 3%. So taking in a lot more than they're sending out in China. That helped worsen the trade balance there. Some of those imports may be fuel related or energy related. I haven't checked out the details, but it's a bit of a pickup compared to what was expected. But that's the big number, the export number. China still facing some issues there with trade on that front. Over in Japan, we had some household spending and cash earnings and whatnot. Average cash earnings are up 1.2% year on year, but household spending looks a bit soggy. It was up on the month, 0.3%, but year on year down 2.8%. So some signs there that maybe there's some little small issues with spending, not really catching up, even though we're seeing a positive month. Some other wage numbers there. Overall wage income 1.2%, overtime pay year on year 0.7%, up from the 0.2%. Wages are a big focus. So I spoke briefly yesterday about a big union. It was a retail union yesterday asking for 6% wage hikes in the next in spring, the next round of wage negotiations. So that's going to play into these numbers there.
And Ryan, we have also, and that's not reported on the calendar for some reason, but the real cash earnings are still down year on year. They're still running at 2.4% this month, minus 2.4%.
Yeah, that was no, you're right. I wrote that down. Then it's not on that calendar. Yeah, down 2.4%. It was estimated to come in down 2.3%, and the previous was down 2.8%. That's real cash earnings. So that's the inflationary impact being seen there as well, as we well know. But yes, well spotted, mate. Over to those fun and game boys at the RBA, or girls now, being the new governor is Michelle Bullock. They hiked rates, as was largely expected being reported, but it was still a bit of a close run thing in real terms. So they hiked again 25 pips to 4.35%. They said that further tightening depends on data and how risks evolve. Now, there's a bit of talk about some language change in the statement. It's a bit potato, tomato, in my opinion. Their old statement said some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame, but that will continue to depend upon the data and the evolving assessment of risks. That got changed from some further tightening to whether further tightening of monetary policy is required, blah, 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 which some have taken to be a bit of a dovish slant. I don't know, as I say, it's a bit of a language change that doesn't really mean much at all. You were up for it, Kay. What did you make of it all?
Yeah, and that's it. The bit of a language. They basically doing what the rest is doing, right? They go completely data dependent. Gives the impression they're happy where they are now. And yeah, we saw this reaction after the RBA. Market probably running a bit long Aussie dollar because of the expectations of saying, because we saw some Australian banks actually saying they may not be the last 25 BPs, but they're really sending us over to the data. And then there we have to note that they're coming out of reasonable data, but then you compare it a little bit with the US, where also we're coming out of a very reasonable month of October, yet the dollar failed to make any headway, and that's a bit the reaction that we saw on the back of the RBA. We also stalled again ahead of the 65.20 resistance on the Aussie dollar. We saw some short covering in EURUSD and things like that. It's putting us to neutral, I guess. That's my take anyway. It's by no means a dovish report, right? We have to make a clear distinction here between position management, change of tone, and doing 180. It's by no means 180, right?
Yeah.
And as we've seen already, we've spoken already about that. Bullock is perhaps leaning a bit more towards the hawkish side than Low was. But that still remains to be seen. Yeah, it's her first, I think, meeting at the helm and decision-making meeting. So
Second, I think.
we'll have to see what's going on now. I think we're getting into neutral territory here and see what happens.
Yeah, I think that the difference between these guys and the rest is that the main reason they hiked is because things like inflation isn't coming down as fast as they want it to. So it's not that inflation has turned around. Their last reading, one of their core measures, the one they look at, fell, I think, to 5.2% from 5.9, something like that. And yeah, it's just things aren't coming down as fast as they'd like them to, rather than everyone else is seeing inflation falling fast, and hence why they're going on pause. And a hike is really only becoming an emergency measure. So the RBA, yeah, keeping the door open. You know, we've been noting since Bullock took over that she's takes a more hawkish tone than Low. She had her first meeting in October, and then this is the one she's pulled the trigger at. So maybe that's backed up those thoughts that she is a bit more hawkish than her predecessor. But yeah, it's the other thing it's shown is what a hike does. You know, these tacked on hikes or threats of hikes, they're not going to see a currency shooting higher. Because, you know, the market still knows that we're pretty much at the end unless things like inflation really start climbing higher again. So these hikes aren't going to have an impact that much. No surprise to see the Aussie dropping after that, not even trying to make a fresh high on the decision. So that gives you a little bit of insight in how things will go. You know, if the Fed pull out a hike at the end of the year, you're probably going to see a similar reaction. The market isn't going to go, oh, quick steam into dollars because the Fed's hiked again. It's going to be, well, that's the last hike, confirming.
This is the kind of reaction we actually had on most currencies of late, showing that the market is starting to feel as well that we are at the end. So the currency, I don't say is going to disconnect with hikes and stuff, but it's the reason why as well. The conditions were already in place. The market had already, let's say, traded in the way. Okay, to give a term that everybody uses, already priced it in. So they got what they wanted, and that does not necessarily create fresh flows in a currency. So especially because it is still for the reason of inflation, not for the reason of, if they would hike in like a hugely positive growth environment, then the currency would have probably stayed high and likely today continue to move higher. But it's
Yeah.
not that reason, right? It's the reason why and the catch up actually on market pricing, which has basically done it. And yeah, I mean, there's not too much more to say about that. Now we need to see what the market wants to do after the fact. We had the short-term reaction. We are still only hours after the reaction, so after the results. So we will have to see what happens in the next few days.
Yeah.
And the dollar should take over really if you look at Aussie dollar right now.
Yeah.
Yeah.
Which it is doing. The dollar's
Yeah.
up across the board at the moment, which obviously we'll speak about. Right, coming over to the UK, and BOE's Peel stirring the pot a bit late yesterday in the UK day, saying that UK inflation remains too high with rates still restrictive. Says it's too early to talk about rate cuts, and that the MPC feels it needs to keep rates restrictive at least for a while. But then added that mid-2024 doesn't seem totally unreasonable for considering the rate stance, which some has thought to be worded as that's when they're going to potentially look at cuts. So that's put in a little bit of a dovish slant, depending on how you want to read that. As we know, as of yesterday, general leanings is that the market sees 2 25 pip cuts by November, one of them by August. So that's potentially up to the timeline a little bit if you want to read that into it. He also added that UK interest rates probably won't go back to near zero, which again is an important reminder that in theory, the next round of rate cuts should be about getting rates to neutral, not wholesale cutting because the economy is doing far worse. Whether that turns out to be the case or not is another matter. But anyway, that's added a little bit more onto the back of the pound this morning. As you can see, cables off as well. We were talking about this all yesterday, and Blake and Dale talking about it on Face, and it remains the point. Why, on the fundamental side of things, why would you be buying the pound? And the fundamentals suggest you wouldn't be buying the pound. So this is why I wasn't too hot about this climbing higher. Yeah, it's cable. It could go to 125, 126 because that's what it can do. But fundamentally, you've always got to come back to the fundamentals and ask the question: is there a good reason why you should be buying the pound cable up in 124s, 25s for a run up to 130? On the UK side, absolutely not. Or an any GBP pair, absolutely not. So anyway, we've had a little bit of a turnaround in the quid. It's following all the others: euro, dollar, yen's up higher, Aussie's down, Kiwi's down, dollar CAD's up. A lot of that to do with what's gone on in commodities as well, which we'll look at also. But yeah, the quid on the back foot once again. Yesterday we're talking is 120.50. Short-term support or support into the end of the year. Who knows? We've had the test, we've had the move. If you've profited in this move, then you need to be locking it in. Hopefully you've taken profit, but this sharp move down, staying below this fib, keeps us in this box. It doesn't yet break this trend. We've had some chances. We've had a bit of a move up. Looked like it might be heading for a break, but we're not. We're still in this downtrend until we start taking out these fibs. That's why I use fibs. That tells me if we're going to start breaking a trend. This move may be strong. Doesn't take us anywhere really. So are we going to collapse all the way back down here? No idea. I've got just as much conviction about us breaking down here as I do as us being up here. So at the moment, just trade the ranges, trade the edges. We've defined again the resistance up here. We've had it previously. We've had it into 125. Our old mate 124.50 is there as well. So you've got your levels here. If you want to be a buyer, then maybe look for 121s again. See if we get a move down there. Given how it's gone up that quickly, it can come down there just as quickly. And then for now, play the range on that one. In further news for the UK, the BRC had their retail sales numbers out for October. This is the British Retail Consortium. They say that retail sales rose 2.5% annually in October. That's down from 2.7% in September, and they say well below their 12-month average of 4.2%. So potentially some weak consumer data to come from the headline numbers for October. I can't remember when we get those, but it'll be in the next week or so. Any comments on Mr. Peel before I move on, Kay?
On the sterling?
Yeah.
No, not really. I think a Peel, who usually is a hawk, all of a sudden giving the market some food on what the market actually thinks about the sterling. So yeah, it turned around again. But as you say, I mean, we were talking about that 124.5 yesterday as well. Yeah, the rest is likely, as I say. I mean, we've seen this snap, this quick move lower in the dollar globally, and then now it's gradually taking some of it back, and then Peel added a bit weight on the sterling shoulder. That's about it. We're turning around the 123, which was a bit of a pivot zone that we've seen of late. Stays below, probably get back to the low 122s, and then reassess what's going on in those in the dollar, really. Yeah,
exactly, mate. Right, well, coming on to a bit more data, we've had some German industrial production. Surprisingly, not looking too good. On the month, down 1.4%. Year on year, down 3.9%. I'll round it up just to impose some more pain on them. So not looking good over there. Spain as well, down 1.4% year on year. Was expected down 2.9%, so not as crappy as expected there. We've got a few construction PMIs out. Italy doing okay there in expansion. Germany doing worse as well. It's getting worse and worse for Germany. There's no pickup at all over there, really. France as well, softening also, and the pan-Eurozone number also showing that coming in softer as well. PPI from the Eurozone as well, nothing much to write home about, all pretty much as expected, 0.5% on the month, down 12.4% on the month, little point worse than expected, but keeps the weaker inflationary picture in play over there. So that will feed through to some of the inflation numbers to come. ECB's Hawke Holtzman urges caution and says we should stand ready to hike again if needed, one of the big hawks over there. ECB's De Guindos says low growth or an economic standstill is expected to continue in Q4 in the Eurozone. As far as ECB goes, they will continue to follow a data-dependent approach regarding future monetary policy. Yesterday, we also got the Canada Ivy PMI, depending on which one you want to pick. One went up, one went down. The main one, 51.9, that dropped from 54.2, but the seasonally adjusted one rose to 53.4 from 53.1 previously. So do what you want with that one. Back to the US, over to the US, Fed Cook says rising yields are not tied to the monetary policy outlook. And Fed Kashkari says he's not convinced rate hikes are over and inflation settling above 2% would be very concerning. In the other news, Janet Yellen is going to meet her counterpart VP of China ahead of a Biden Xi summit. That meeting from Yellen is going to happen this week. Not sure exactly when, but that's coming this week, so we could get some comments there. The comments of late from these guys have been a bit more conciliatory, so maybe we'll see a bit more of that continuing. It's funny, it's chalk and cheese. You get these meetings and they talk nicely, and then 2 minutes later, the US is slapping more sanctions or hitting them with about chips and all that sort of thing. So you have to, they speak out of both sides of their mouth. You have to take it with a pinch of salt. But anyway, that might produce some headlines if tensions are easing further there. Kay, got anything that's hit your radar?
Yeah, in other news, and I'll show it in a minute, is the Swiss reserves coming out, FX reserves coming out for October this morning. And surprisingly, well, surprisingly or unsurprisingly for the Swiss, sorry, it's come down again. Now there may be some revals in there on because it's expressed in Swiss franc, right? And the Swiss franc strengthened a bit during the month of October, but it's very surprising that those FX reserves levels are still coming off. It looks as if the S&P hasn't been smoothing anything of the Swiss strength during October on the back of the safe haven buying. On the contrary, their foreign FX reserves are still coming off, which could suggest that they were still on the other side of the coin and still buying Swiss franc regardless what happens anywhere else. I'm going to show it. It's pretty impressive what happened since the height of the pandemic. It's really crazy. We are nearly back at 2016 FX reserves levels there. As you can see, in the month, it came down by another 20 billion Swiss franc equivalent. It's special. What the S&P is doing is really special. So yeah, I'm going to have a look at the graph to show you. I really thought that sooner or later it was really time to start to sell Swiss franc because their CPI is back within their range. Their data are a bit weaker coming out, which should hold them back from hiking more. But they did say at the beginning that a strong Swiss franc was good to combat CPI. But at some stage, they should really stop buying a Swiss franc because they are where they want to be. But they do seem to just continue to press the pedal and I guess that in the next FX report by the US Treasury, Janet Yellen will have stumbled upon her lightsaber sword and come out with another report against Switzerland, and they're probably going to do as usual, stick up the middle finger and tell them that it's none of their business.
Yeah, shovel up your carriage clock. Yeah, your cuckoo clock.
Yeah, it's one really on it was on my radar really to look for levels to sell Swiss franc because I think those FX reserves are they should stop selling Swiss franc at one stage and give us the nod for it, but not today yet. They're saying not today.
No, exactly. Well, I'll let you look at the Swissy pairs. Right, so what has been going on? Well, again, looking at the euro, a bit like cable, you know, signs that we might be starting to take on this trend. Got above the 107, fell short with a fib up here. Now we're potentially going back in the box. This level was important for holding one down to probably 106.90, 95. It needed to hold here. If you're going to get a break, you want to see the break supported. It isn't supported, so we're back under. Doesn't mean we can't go back above it, and the line might become wishy-washy, but this is my point of interest. This is my pivot line. This tells me if we're heading higher or if we're staying in range. For now, it looks like we might be going back into the range. We've had our little fun and games above. Now we're going back down here. Does it mean we're going all the way back down again? No, not necessarily, but it just means that if we start to see 107 resisting now, then we are going to be playing that game of mooching around in this area. And then I'm unlikely to get much involved, and I'll just wait to see what happens at the edges. I've been slicing and dicing my longs, still holding some. I was looking for a hold of 107, 106.90 to add back into my position, see if we could get this move back higher and a proper break. But I'm holding off because we're back below 106.90. So I'm back to being neutral and sitting on my hands and just managing what I've got. I haven't really yanked up the stops on my 105s yet. I might have a think about that, see what the price action does today. Maybe bring it well up into the 106s, mid 106s, something like that. I'll have an assessment on that. But yeah, and I said, you know, it's a similar pattern all the way around. Cable shown the same, had to go up. Now we're failing. Aussie dollar as well, hit that zone I've been banging on about, pretty much on the nut, 65.20s, prior resistance, old support and resistance area. Couldn't get through, and now we're turning tail again. This one I think is a bit more in danger because we haven't got the confirmation of the downside. A bit like we had in cable and the euros, we've been pointing out, you know, everything happened before. That was your area where support looked like it was coming in, but then we broke it. So this one I think is in more danger of maybe testing the lows than some of the other pairs. But, you know, still holding up about 64. So that's going to be a bit constructive. If we remain above 64, that's going to be my level down here. Below there, then I think maybe we're going to have a look at the lows again, and we'll see what happens down there. If we hold that low or hold this low, that will start to solidify the bottom. But if we get below, you know, 63, 63.15, and if we nick a new low, then potentially the trend is going to continue, and we're going to see more pain to come. A lot of this stuff looks to be driven. We've got a move in yields, generally lower, which isn't usually helpful for the dollar. But in this case, we're seeing the dollar moving up. I think a lot of it is down to commodities. We've got a bit of a breakdown in oil. So it's no surprise to see the commodity currencies moving on the back of that. Gold as well coming down, silver coming down, you know. So a commodity blitz, if you like, is hitting the commodity FX. Dollar CAD is zooming up. Where are we? Oh, I can't even find it. Where are we? Got too much on my page. Dollar CAD came down, had a move under 136.50. This again, another bit of a pivot line. Decided it want to stop around the 20s. We're having a move back up. So are we going to take these highs again, have a go at 139? When we were up here, I thought we might be heading towards 140, something like that. And, you know, what a difference a day makes. You turn around yesterday and next minute you're wondering if you're going to see a test of the, you know, 135s, 134s. But again, we flipped around again. As I say, commodities doing a lot of the driving this morning. You can see that in a lot of pairs. Kay, what are your thoughts generally today? We've had a big move up, a big move down, and now a bounce, and, you know, it's giving clear direction, is it? You think something's moving finally, and then it pulls the rug out.
Yeah, that's, you know, brings us back to what I've been saying for a while now. It's very hard to see something move in one direction for more than 2 or 3 sessions, right? Yeah, as you say, yesterday it was relatively quiet. It had the looks of levels starting to hold. Bit of retracement in US yields, and then, but today they're actually coming off a little bit, and yet the dollar still finds enough of a bit. So that tells me we are still, dare I say, in the broader ranges, and it's still very hard to if in short, if you see decent money in the way of what you think the market is going to trade, take it, because as you already said, Ryan, I mean, yesterday cable was looking so big at the end of last week. The accelerations we saw were quite actually impressive, 300 and a bit points in 2 sessions basically, which is a pretty decent move. And then if you woke up too late today, you already missed 150 to the downside, so or 140. So that's what I'm saying. I continue to trade it the way that I'm seeing, and my ideas are. I still don't like a few currencies, but you can't stay in the position for more than 3 or 4 days unless you want to start to construct a position for 4 weeks, and then you can leave yourself a lot of leeway. But there's enough in those moves intra range to fool around in. Like, for instance, I sold gradually euros on the way up. I bought them back today. Even if it goes lower a little bit, I still think we are we are in ranges, and I'm happy with the points that I made on the back of it. Our short EURUSD going from last week up from the fixing, the end of the month fixings up in the 167s. I've been taking gradually stuff off. I've been playing a bit of ping pong over the RBA overnight, so my average was well, actually there was never any risk. And then to overnight I said, well, if it goes back above well above 166, I'm out of there on the rest. So that's what I did. Pips banked, and what's next, you know? And don't be. This is a market where really psychology will come into play a lot. You don't be disappointed if you have a position and it goes like the extra 15, 20 points, and you've already taken most of it off or so. There are opportunities within all those ranges and stuff, and it's really a case of not being disappointed with stuff, because the next opportunity is really literally right around the corner, and it's okay to just bank what you have and then move on to the next one, you know.
Yeah, exactly. I was looking at dollar yen. I had a nice short off the top and got stopped out 149.85 on the trailer. Still well in the money. But you're right. You know me, and we always try and say it. If you're in a position, there's nothing we're trying to push it as far as it goes, but make sure you're protected behind it. So if you get in a move, if you shorted cable up here into these highs, great. You got a great trade on, but don't sit there with all that profit and think, right, well, I want another 100 pips out of it. You know, you should be taking some off the table. You should be locking in your stock behind it. So if this does a flip around today and we go up to 125, you haven't evaporated all your profits. You've put some in the bank. You've protected the rest. And like Kay says, you know, yeah, if you get another 30, 40, 50 pips, great. But if you don't, you need to have taken some money and put some in the bank, just in case it flips around again. So, you know, same with people who are long. If you were long up down here and you were up here thinking, yeah, this is great, I'm going to wait for 126 and not do anything, well, you've given back 140 points. So yeah, you know, take some money off the table, because as you can see, one day is different to another day. We can wake up in profit one day, wake up the next day, and you're staring a loss in the face. So be nimble. Don't marry your positions, and protect them as much as you can.
Slice and dice. Slice and dice.
Slice and dice. Put the rabbit in the bag, as Brian says. Put the rabbit in the bag. Yeah. Just make sure it's a big bag for lots of rabbits. Right, Kay, do you want to have a look around?
Yeah, quick one. Just in the Q&A, I think Charlie. Yeah, I'll have a look at Euro Swiss, but then I think the most, unemployment beat expectations, but I think the most really is still, we're still living under the influence of what the S&P is doing, right? Sometimes data in Switzerland are what they are, because we've seen weaker data coming out earlier and during the month of October, and yet Swissy wasn't reacting too much of it. This is the picture. Thanks, Magic, by the way, for producing this in our chat room. This is a picture of the S&P reserve. So we hit the top there in December, and that's where they went, all right, this is enough to combat the inflation. They recognized, and no wonder, because the Swiss are pretty money savvy. They recognized pretty early as well that to combat inflation, a strong currency would be good, and they just announced it. Saying that they would buy Swiss franc, regardless what everybody else thinks about it. But then we were like, okay, they're probably going to, there's a fair chance that they're going to undo what they did during the pandemic. But now we're already at levels that we only saw back in 2016, 2017, which is very, very strange. So they really, really, really pressed on with a lot of Swiss buying. Jordan, in his latest comment, is still repeating that they are not ready to give it up yet. This is very surprising because we thought that they could get back to 2018, 2019 levels and then assess the situation. That's also one of the reasons I started actually to buy a bit of dollar Swiss the other day, which is okay. I took some profit on it, but then those guys continuing to do what they are doing is really holding me back from trying to do it again. There will be a day where they stop, of course, but that day doesn't seem to be today yet. So this is quite an impressive move. A lot of people are scratching their heads around it. And as I said, I reckon US Treasury in their end of year report about what other countries are doing in FX is probably going to point fingers at the S&B again, and likely a bit more vocal than they were thus far. But again, the Swiss, as usual, are probably going to show them their back and just continue to walk on their own path. Right. Again, we're going to look. This is one of my regular features, right? This is what pushed me somewhere to buy back the euro dollar I was short, because we had this little tightening in differentials between the EU and US short rates. Yeah, it's a bit lower. Already the euro dollar now, the dollar is really outshining the rest today. But those differentials are not coming back too much. The European yields are not really following stuff like the gilts, for instance. We've seen a big setback, and therefore I think the euro dollar could rather be in a range compared to the rest of the currencies, and the rest gravitate around. You know what I mean? And on the contrary, if you look at that, and of course, PIL is in here, but if you look at that, we had this double tightening, and this is the tightening where you went like, all right, this is your cable rally, right? And then you go like, okay, cable may be staying up here, but then all the different maturities along the UK curve are really being hammered again, and we are virtually back to the middle of that lower end of the range, has to be said, of the last months, and that's really that which harmed the sterling. So yeah, I'm just giving those two examples. You can find it back in other currencies as well. If you want to look at those, fine. I'm just showing these because we keep on hammering about the importance of what's happening in the yield market. Not sure that we can really put trend lines on those things, but at least the horizontal one here has been broken again to the wider side of things, which should bring us back to cable, maybe a sell on rallies if we see a little move tightening again in these differentials. So that's all, or most of it, down to PIL. US 10s, they're trying to figure out what's going to happen here. We had a bit of a move back up. We are hanging around these 460 here right now. Again, we do have a fair bit of bond issuances this week, also some corporate bond issuances that may have an impact on various sides of the curve. Sorry. So keep an eye on what's going on, because they really market seems to be plugged into it again right now, and the reason that the dollar is crawling back up was a bit better yields and a bit wider differentials again in favor of the dollar. And there's still not a lot of there's a lot of Fed speakers coming up, but there's not a lot of data I see on the calendar before tomorrow, right? Tomorrow we start?
Yeah, not a lot today, mate.
Yeah, okay. Okay, so Ryan already covered the euro dollar. I just want to show something in the cable here. Yesterday we spoke about that 124.5, ended up just short, and now we are back around this 123, you know, where we had like some decent activity, and as a matter of fact, we're turning around right now. A bit of support, perhaps 122 3/4 80. I'd keep a close eye on what's happening in the low 122s. Was a bit of trend line action there, a bit of fib action there as well. Keep an eye on what's happening in the low 122s if ever we get there, because this could be something where if people want to be a bit dovish dollars or whatever, we could see some bits creeping in cable again. Why not? Dollar yen, I'm not going to extend too much on it. We held those supports. We are back around the 150.5. I know where dollar yen is going to be on Friday at 3 p.m. our time. I think he's going to be bang on the 150.5 where my call strike lies, and I'm going to be trading it around. Not a lot more to say really about it. Yeah, we need to keep an eye on this on Aussie, right? Rejected the 65 2025 again. That is one thing where we know now that this looks a bit rich, but we are coming into support here around 64, call it 1020, 64 1020, bit of support, a bit more around 63.80 likely. But if we would get back down here, so just psychologically below this 64, the figure, it could look like this move is already over, and why not? We are going to retest those lows. But that is, I reckon now it's the dollar side who is going to tell us what we need to do with the various currencies. And also, there's one that we need to. This one, Raphael brought up the dollar Noki this morning, and then I went on to the euro Noki. Noki has been extremely weak, right? Extremely weak. Just can't hold a bit for more than hours or a day or so. But we are at a very important level here on the euro Noki, just in the 1190s. If that goes on a daily close, then we're probably going to retest those highs that we saw here in May, above 12. And especially if those oils continue to come lower, if energy continues to come lower, if gas continues to come lower, Norway being a big exporter of all those things, that could really hurt the Norwegian kroner. And also,
winter's coming, mate. Winter is coming.
Yeah, I mean that. But the thing is as well is that Norges Bank is still selling Norwegian kroner every day, and that's not helping. But if winter comes, as Ryan says correctly, we may be just maybe in for a bit of an overshoot and then start to correct. But for the time being, I'm not going to stand in the way of all those things. Really, I don't have much more to say. This gold is still in a range. We're starting to get closer to the underside of the range. One door that may start to look a bit more interesting again is silver. If we make it into those low 22s, okay? Watch what data are going to tell us. I'm still not in a hurry. But this one is a level of interest to me in those low 22s. And Greg also mentioned that last week and then repeated it this morning. And with that, Mr. Ryan, back over to you.
Thank you very much, sir. Thank you for your valuable insight as always. Yeah, I think the main theme for today is just watch your levels. You know, don't get caught out in a move. Don't just buy a cable because it's dumped 100 pips or anything like that. It's carve through the levels, pick the places you would rather trade it, and that goes the same for all pairs. And keep your trades tight. You know, if you're wrong, don't be wrong for a lot, be wrong for a little, and then you can come back and fight another day. And that's that for today. Have a wonderful day trading, and we shall see you all, as always, nice and early tomorrow. Have a great day, everyone. Thanks, Kate.
Cheers, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.
you.